The same car is with me, driver is with me. I meet my relatives. While coming out, they are giving me shagun, maybe 500, 1,000 rupees, 2,000 rupees, 5,000 rupees, whatever it is. Higher the amount they will give, better the tip I'll give. You know why? Because my mind says that this is not your money. Although moment I get that money from them, it's my money, isn't it? This is called mental accounting. And this is the mental accounting which made you to sell why. Why? It happens that you have given 50 rupees hard earned money. 25 rupees, market has taken back your hard earned money. This 25 rupees has given to you by market. You love this 25 rupees more than this 25 rupees. Are you getting my point? You don't want to throw away your hard earned money. You want to get it back from the market, from the same stock. That's the mental accounting. So to understand equities, I'll not go too deep into it. Just understand one nature only. You have good advisors to advise you. So they will take care of all these mental blocks. But come to what equities are. We need to understand. Equity is not an investment for the capital appreciation. Equities are the investment for the profits. And profit is the fundamental return of the equity. So how does the price discovery in the market takes place? We'll discuss it out. So first, let's see how the equities perform. The relation of time and returns. This is an investor who is investing in Nifty for the last 20 years. Every day he invests for the last 20 years. As soon as the market opens, he invests. He strongly believes that equity is something which generates good profits. He doesn't do any research. As soon as the market is open, he invests, right? And he's investing for the last 20 years. But what he does, with every transaction, whatever he has done, he has invested only for 1 year. Every transaction, whatever he invested, he has kept money only for 1 year. Look at this. After 1 year, when he withdraws money, I have calculated his returns. This is 0. Above 0, these are profits. And below 0, these are losses for the last 20 years. So what you observe, friends, here? What you observe, friends? Profits are more, losses are more. Profits are more, no? Look at the probability of profits, much higher than probability of losses. The wonderful thing with equities. But what is the bad thing? Huge losses as well. And what is the worst thing? The worst thing is, look at the volatility. The volatility. Sometimes you have huge profits, sometimes you have huge losses. And to calculate volatility is deviation from the average profits. So to calculate volatility, we have a statistical tool called standard deviation. Standard deviation is a measure of risk. So what is the risk here? 29.78% is the risk. Look at the risk, so high it is. How volatile the investment is. So this is for the person who has invested money in Nifty, the 50 good stocks of India. He invested every day for the last 20 years, but kept his money for only 1 year. Look at the second person. He invests the money in the same stock, same 50 stocks of Nifty, same price, everything is same. As soon as the market opens, he invests in these stocks. There is no difference between the two investments. But there's only one difference. The first person keeps his money only 1 year, and he is keeping his money for 5 years. What you observe here, friends? Nothing changes except time. What you observe here? Look at this. What happens here? This is 0. These are your profits and these are losses. The probability of profits are so huge and hardly any losses. And look at the volatility measure of risk. Risk from 30% has come to almost 11. Right? Look at the third person. He is investing in the same 50 stocks, same NSE, at same price, same day. But instead of keeping his money for 5 years, he keeps his money for 10 years. What you observe here? No losses. And look at the risk, is 2.5%. Look at the fourth person, 15 years. So as you increase the time, your performance better, isn't it? Simple question, why it happens? Same price, nothing is changing, friends, nothing is changing. But your performance is better if you have given the long time. That's why we call equities a long-term asset class. It's not a short-term asset class. In fact, let me tell you, friends, equity is the most predictable asset class. What does it mean? If you ask me, after 15 years, where the company profits will be, Perhaps I'll be very comfortable in saying you, if today the Sensex profits are 1500, after 20 years the Sensex profits will be 7500. I'll be very comfortable in saying this. But if you ask me, today interest rates are 6.75%, where they will be after 20 years, I can't say with the same confidence. Equities are the most predictable asset class, friends. Why it happens? Let us understand this. How does the price discovery takes place in the market? How a particular share price is discovered in the market? That will lead us to understand why it happens. So the equation for the discovery of the price in the market is very simple. Price of a share is equal to profits of the company multiplied by sentiment towards the company. As simple as that. Profits multiplied by sentiment towards the company. We'll write it like this. Price is equal to earning per share, which is for profits, multiplied by sentiments. Now, how to measure sentiments? How to measure sentiments? It is something like this. Assume that you want to do FD in the bank. Assume that you want to do FD in the bank. And FD says that we will pay you 8% interest. So if you open FD today of rupees 100, how much money you will get after 1 year? 8 rupees. So what's your earning is? Your earning is 8 rupees. To earn 8 rupees, how much money you have paid? 100 rupees. So this is the price. Price and earning, right? Now similarly, assume that there is a company X, and company X has reported a dividend of rupees 10 or profit, whatever you say, dividend, EPS, profit, whatever you say. Company has reported the dividend of rupees 10. Now company promoter says to you, you are investing in FDs, you are earning 8 rupees, my company is paying 10 rupees. You will get 10 rupees by investing today. After a year you will get 10 rupees of dividend. At what price you will buy this? The company which can give you 10 rupees. FD will give you 8 rupees, right? At what price you will pay this? What price you will pay for this? What price you will pay? You have to pay 100 rupees to earn 8 rupees in bank. So to earn 10 rupees from company, how much money you will give to the company? 120. How much you will give? Give me some money. How much you will give, sir? How much you will give? You know what will happen? Let me tell you. Each one of you will give me different figures. Why? Exactly. Hang on. You're getting my point. And that's why, since every person has a different sentiment, the price of the share keep on changing every minute in the market. Although the profit of the company remain same. That's why the price of share keeps on changing. So what is the calculation now? How we calculate the sentiments? We calculate sentiments like this. If we have a better sentiment, you will be ready to pay me 120 rupees. If you have normal sentiment, you pay me only 100 rupees. If you have poorer sentiment, perhaps you will pay me only 80 rupees. So you are paying 120 rupees to earn 10 rupees. You are paying 100 rupees to earn 10 rupees. You are paying 80 rupees to earn 10 rupees. So good sentiment is 12. Normal sentiment is 10 and poor sentiment is 8. And we call it price earning ratio. This is called price earning ratio. So what you observe here, higher the PE, better the sentiment, lower the PE, poor the sentiment. Are you with me? Getting my point? Right? Now assume that. What happens? What's happening in the 1 year and what's happening in the 15 years? Let us understand this. To understand this, I'll give you two dates. The date is 17th May 2009. The second date is 21 to 23 May 2014. Any idea what are these dates for? Election results, right? 17th May 2009, what has happened? The market opened, Sensex gained 2,200 point. 2,200 point. In percentage terms, Sensex gained by almost 20%. Almost 20%. Circuit breaker. Market was closed. During these 4 days, market gained 25%. Market gained in a single 25% in 4 days. Now, very interesting thing. Look at this. Why market has such a rise here and why market has such a rise here? ध्यान से सुनिएगा इस बात को. यहां पर टीवी हमको बोलता है मार्केट इसलिए बढ़ गया क्योंकि डॉक्टर मनमोहन सिंह वापस आ गए हैं, और दूसरे में बोलता है मार्केट इसलिए बढ़ गया क्योंकि वो चले गए हैं. This is called sentiment. So whenever we invest in markets, we look at sentiments. So what's our equation is? Our equation, friends, is very simple. If you invest for short term, how the price discovery takes place? How the price discovery takes place? Price is equal to EPS multiplied by PE.